What if I told you that everything you have been taught about building wealth through real estate is only half the story? What if the house you bought, the one everyone told you was your greatest investment, is actually costing you more than it is making you? And what if the stock market, the thing most people avoid because it feels too risky, too complicated, or too unpredictable, has been quietly turning ordinary people into millionaires for decades? Here is the question that nobody in personal finance wants to answer honestly. When you put your money into real estate versus the stock market, which one actually wins? Not in theory, not in a motivational seminar, but in real numbers, with real math, over real time. That is exactly what we are going to break down today, dollar by dollar, return by return, so that by the end of this video, you will know exactly where your money works hardest for you. Welcome. I am Ron, and this is your go-to channel for finance automation, smarter investing, and building the kind of wealth that actually lasts. If you are new here, hit that subscribe button right now so you never miss a video like this one. And if this topic already has you thinking, go ahead and smash that like button. It takes 1 second and it genuinely helps this channel grow. Now, let us get into it. Let us start by setting the stage, because before we can compare real estate and stocks, we need to understand what we are actually comparing. These are two completely different asset classes. They behave differently. They reward you differently. They punish you differently. And they require very different things from you as an investor. So let us lay the foundation first. Real estate is what most people think of when they hear the word investment. You buy a property, a house, a condo, a duplex, and over time, that property is supposed to go up in value. You might rent it out and collect income every month. You build something you can see, touch, and feel. There is a psychological comfort to real estate that you simply cannot get from a stock ticker on your phone screen. Most people grew up hearing their parents say, "Buy a house. It is the best investment you will ever make." And that idea stuck. Stocks, on the other hand, are ownership stakes in companies. When you buy a share of a company, you own a tiny piece of that business. If the company grows, your share grows. If the company pays dividends, you get a cut of the profits. And when you invest in something like an index fund, which tracks hundreds or even thousands of companies at once, you are essentially buying a small piece of the entire economy. Now, here is where it gets interesting. Let us talk about the numbers, the actual historical returns, because this is where most of the debate lives. Over the last 50 years, the United States stock market, specifically the S&P 500, has returned an average of roughly 10% per year. Some years it is up 30%, some years it is down 20%. But when you zoom out and look at the long-term average, it lands around 10% annually. After adjusting for inflation, because a dollar today is worth more than a dollar 20 years from now, you are looking at a real return of about 7% per year. Now, let us look at real estate. According to data from the Federal Housing Finance Agency, home prices in the United States have appreciated at an average of about 3 to 4% per year over the last 50 years. And after adjusting for inflation, you are looking at a real return of roughly 1 to 2% annually on the home value alone. Wait, 1 to 2%? That sounds terrible compared to 7% in stocks. So why does everyone keep saying real estate is such a great investment? This is where the conversation gets more complicated and more honest. Because here is the thing. When people invest in real estate, they are almost never using only their own money. They are using leverage. Let us walk through a real example to make this crystal clear. Say you buy a house for $300,000. You put down a 20% down payment, which is $60,000 out of your own pocket. The bank loans you the other $240,000. Now, if that house appreciates at 4% per year, after 1 year, it is worth $312,000. You made $12,000 on a $60,000 investment. That is a 20% return on your actual cash invested, not 4%. That is the magic of leverage. And it is the single biggest reason why real estate has made so many people wealthy. You are using the bank's money to amplify your gains. But, and this is a very important but, leverage cuts both ways. If that same house drops in value by 10%, it is now worth $270,000. You have lost $30,000, and you still owe $240,000 on your mortgage. Your $60,000 down payment just got cut in half. In fact, if you had to sell, you might end up with almost nothing after paying off the loan and covering closing costs. This is exactly what happened to millions of Americans during the 2008 financial crisis. Prices dropped, and people who had used leverage found themselves underwater, meaning they owed more on their mortgage than the house was actually worth. Some lost everything. So the power of leverage is real, but so is the risk. Now let us talk about the costs of real estate. And this is the part that most people dramatically underestimate. When you buy a home, you pay closing costs that typically run between 2 and 5% of the purchase price. On a $300,000 home, that could be anywhere from $6,000 to $15,000 right off the top. Then you have property taxes, which vary by state and city, but average about 1 to 2% of the home's value every single year. That is $3,000 to $6,000 per year on a $300,000 home. Money that goes straight out of your pocket year after year, regardless of whether your home is going up in value. Then there are maintenance costs. The general rule of thumb is to budget 1 to 2% of your home's value every year for upkeep and repairs. That covers things like a new roof, an HVAC system, plumbing issues, appliances, landscaping, and all the little things that go wrong with a house over time. On a $300,000 home, that is another $3,000 to $6,000 per year. And if you are carrying a mortgage, which most people are, you are also paying interest. On a 30-year mortgage at a rate of 7%, which is close to where rates have been recently, you will end up paying more in interest over the life of the loan than the original price of the home itself. That is not a typo. On a $240,000 loan at 7%, you will pay roughly $330,000 in interest over 30 years. You paid $240,000 to borrow $240,000. Think about that. So when you add all of this up, closing costs, property taxes, maintenance, insurance, and mortgage interest, the total cost of homeownership is staggering. And this is before you even consider. If you are buying an investment property, a home or apartment building that you rent out to tenants, you are no longer just hoping for appreciation. You are generating cash flow, and cash flow changes everything. Let us say you buy a rental property for $250,000. You put down $50,000. Your mortgage payment, taxes, and insurance total about $1,400 per month. You rent the property out for $2,000 per month. That leaves you with $600 per month in cash flow, before maintenance costs and vacancy. Over time, your tenant is essentially paying down your mortgage for you. The property is appreciating, and you are collecting passive income every single month. This is the model that has made countless real estate investors wealthy, and it is a genuinely powerful way to build wealth. But here is the catch. Being a landlord is not passive. Not really. You have to find tenants, screen tenants, deal with late payments, handle maintenance calls, navigate local housing laws, and sometimes go through the painful and expensive process of eviction. If you hire a property management company to handle all of that for you, they typically charge 8 to 12% of your monthly rent. That eats into your cash flow significantly. And then there are the vacancy periods, months where the property sits empty and you are covering the mortgage out of your own pocket. Bad tenants who do not pay. Major repairs that come out of nowhere. The hot water heater blows up the same week the roof starts leaking. This is the reality of rental property investing that the weekend seminars and the YouTube highlight reels tend to leave out. Stocks, by contrast, require almost nothing from you. You open a brokerage account, invest in a low-cost index fund, set up automatic contributions, and walk away. There are no tenants to manage, no roofs to replace, no property taxes to pay, no maintenance calls at 11 o'clock at night. The market does all the work, and the fees? Almost nothing. A typical index fund charges an expense ratio of less than 0.1% per year. That means on a $100,000 investment, you are paying less than $100 in fees annually. Compare that to the thousands of dollars in annual costs associated with owning a property. But stocks have their own challenges, and we need to be honest about those too. The biggest one is volatility. The stock market can drop 30, 40, even 50% in a short period of time. During the 2008 financial crisis, the S&P 500 dropped nearly 60% from its peak. During the COVID crash in March 2020, it fell 34% in about 30 days. If you are not prepared for that, if you panic and sell when prices drop, you lock in those losses and you miss the recovery. This is why so many people fail at stock market investing. Not because the market does not work, but because they cannot stomach the volatility. They buy high when everyone is excited, sell low when fear takes over, and end up worse off than if they had done nothing. Real estate, on the other hand, does not give you a daily price update. You do not wake up on a Tuesday morning and see that your house is suddenly worth 20% less. Even when the market is declining, you are somewhat insulated from the psychological pain because the number is not flashing in front of you every hour. This stability, or at least the perception of stability, makes it easier for many people to stay the course. Now, let us bring this all together with a head-to-head comparison over a 30-year timeline, because that is really what matters. Investor A puts $60,000 into the stock market and invests another $1,000 per month consistently for 30 years. At a 10% average annual return, after 30 years, Investor A has approximately $2.3 million. They never called a plumber. They never chased a late rent check. They never paid property tax. Investor B uses that same $60,000 as a down payment on a $300,000 rental property, collects rent, pays the mortgage, and handles all the associated costs. After 30 years, if the property appreciated at 4% annually, it is worth approximately $970,000. If they were disciplined about reinvesting their cash flow and paid off the mortgage, they might end up with the property free and clear plus some additional savings. Call it $1.2 to $1.5 million in total net worth, depending on how well they managed costs and vacancies. Investor A wins in pure numbers, but Investor B has a tangible asset, a paid-off property, and potentially strong cash flow in retirement. The honest answer is that neither one is definitively better for everyone. The best investment is the one that you will actually stick with, the one that fits your risk tolerance, your available time, your financial situation, and your personal goals. What we can say with confidence is this: the math on stocks is extraordinarily powerful when you give it time and stay consistent. The math on real estate is powerful when you use leverage wisely, manage costs tightly, and invest in cash-flowing properties. And the math on doing nothing, leaving your money in a savings account, spending it instead of investing it, waiting for the perfect moment, is devastating. That is the only guaranteed way to lose. The wealthy do not sit on the sidelines debating which is better. They invest, they diversify, they let time and compounding do the heavy lifting. And many of the most financially successful people you will ever meet have both real estate and stocks in their portfolio, because they understand that you do not have to choose only one. So, house versus stocks, who wins? The real answer is, it depends on you. But armed with the real math, you are no longer guessing. You are deciding. If you want simplicity, low costs, and the compounding power of the global economy working in your favor with almost zero effort on your part, the stock market is hard to beat. Open a brokerage account, invest in a diversified index fund, automate your contributions, and let time do its thing. If you want leverage, tangible assets, monthly cash flow, and you are willing to do the work, or pay someone else to do it, real estate can absolutely be a wealth-building machine. Just go in with your eyes open, understand all the costs, and make sure the numbers actually work before you buy. But whatever you do, start. Because the biggest financial mistake is not choosing the wrong investment. It is choosing to wait. If this video helped you see your finances in a new way, I want you to do 3 things right now. First, hit that like button. It takes 1 second and it means the world to this channel. Second, subscribe so you never miss a video on smarter investing, finance automation, and building real wealth. And third, drop a comment below. I want to know, are you team real estate, team stocks, or are you doing both? Let me know. I read every single comment. I am Ron, and I will see you in the next one.